Decoding Canada's Rental Income Tax, Section 2116 explained. Canada non-resident rental income tax requirements. Understanding Section 216 tax. Non-resident individuals who own rental properties in Canada must comply with specific tax requirements set by the Canadian government. One crucial aspect to consider is Section 216 tax, which governs the taxation of non-resident rental income in Canada. Understanding these regulations is essential for individuals looking to generate rental income in Canada while living abroad. What is non-resident rental income? Non-resident rental income refers to the money earned by individuals who are not Canadian residents from renting out properties in Canada. This income is subject to taxation under Canadian tax laws, even if the property owner resides outside of Canada. Non-residents must report this rental income to the Canada Revenue Agency, CRA, and adhere to the tax regulations outlined for non-resident property owners. Section 216 Tax Overview. Section 216 of the Canadian Income Tax Act outlines the tax requirements for non-resident property owners earning rental income in Canada. Under this section, non-residents are required to file a Canadian tax return and report their rental income. The taxes must be paid on the net rental income earned from Canadian properties after deducting eligible expenses related to property maintenance, management, and other allowable deductions. How is Section 216 tax calculated? Calculating Section 216 tax involves determining the net rental income earned from Canadian properties and applying the applicable tax rates. Non-residents can also claim deductions to reduce their taxable rental income, such as property taxes, maintenance costs, and property management fees. Understanding the deductions allowed under Canadian tax laws is essential for optimizing tax efficiency and compliance. Important considerations for non-resident property owners. Non-resident property owners in Canada should be aware of the following key considerations when dealing with rental income taxation. Filing deadlines. Non-residents must file their Canadian tax returns reporting rental income by specific deadlines set by the CRA. Failure to meet these deadlines may result in penalties and interest charges. Withholding tax. Non-resident property owners may be subject to withholding tax on their rental income, which is deducted at the source by the tenant or property manager. Understanding the withholding tax rates and regulations is crucial to avoid any tax implications. Documentation. Keeping accurate records of rental income and expenses is essential for tax compliance. Non-residents should maintain detailed documentation to support their tax filings and deductions claimed. Expert insights on Canada non-resident rental income taxation. According to tax experts, staying informed about the tax requirements for non-resident rental income in Canada is vital for avoiding potential issues with the CRA. David Smith, a tax consultant, emphasizes the importance of seeking professional advice to navigate the complexities of Section 216 tax and ensure compliance with Canadian tax laws. In conclusion, non-resident rental income tax requirements in Canada, particularly under Section 216 tax, play a significant role in the taxation of rental income earned by individuals living outside the country. Understanding the regulations, calculating taxes accurately, and meeting filing deadlines are essential for non-resident property owners to fulfill their tax obligations in Canada effectively. By adhering to the guidelines outlined for non-resident rental income taxation, individuals can navigate the Canadian tax system with confidence and ensure compliance with the applicable laws and regulations. Have questions about Section 216 tax filing? Call 416-283-8774 or visit www.theaccountingandtax.com for expert help.